Why traders should use the Relative Strength Index tool. The RSI is a momentum indicator used to analyze the overbought and oversold conditions of a given stock. Relative means this indicator depends on other factors to arrive at a point in the technical analysis process. The conditions that determine the performance of RSI are based on prime values where prices climb or drop to levels below market expectation. If the indicators start to rise beyond 70, the stock is overbought, and if it goes below 30, it signals the stock is being oversold. These conditions provide an index interpretation of the market's security performance, whether there's a devaluation or overvaluation of the securities. Whatever the indicator reading is, it should be an indication for your decisions. Trading tools have one fundamental importance, which is to help maximize profits for a trader. They are either used to prevent any possible loss or to increase profits. Whatever technical requirements a tool may have, its sole purpose is to grow the profit margin to the highest possible levels. The RSI is designed like an oscillator because its line graph moves between two extremes to alert a trader of what trend is developing. It oscillates between the buoyant and bearish levels to warn traders by producing an indicator that will cause a trader to initiate a reversal, pull back pricing. Intraday Forex trading can take advantage of the RSI indications to predict a market as overextended. The result calls for retracing as a corrective measure. Each of those two extremes is meant to initiate an entry point or an exit as a remedial measure. As momentum changes, so do price changes, with a possible rise to turning points, which call for action to reverse an extreme trend. It bases its concept on price history performance by fusing the two averages of securities over a period to determine the oversold or overbought trends of a stock. This tool can measure the relative values of several securities, such as bonds, futures, options, commodities, and currencies. Being an oscillator model, it predetermines the ideal conditions to sell or buy a security. For a trader, that is a worthwhile investment used primarily to locate periods ideal for trading. When prices start climbing, they may level out as a constant or continue to climb steadily for some time. As it continues to climb, a trader will most likely sell his commodities. Equally, when the trend reverses and prices get on a downtrend momentum, traders will begin to withhold their securities or may opt to buy new stock instead. RSI provides traders with signals that indicate when prices are climbing or descending. When value drops, that does not indicate that you may buy new commodities and make profits. If they rise, you may need to study its momentum to ensure that you'll make profits if you begin to sell your commodities. Therefore, the Relative Strength Index is an essential tool for traders who want to maximize every condition positively. To experience the full benefit of this tool, you must master it by evaluating the overbought against the oversold securities.